Building Wealth Recession 2023. Recession is something that doesn't occur often, but is something that we all should be aware of. The length of an economic recession is between 2 and 18 months, with the average being around 18 months. Currently, there are some indications that a recession is on the horizon, and it's time to start planning for it. The goal is that you'll be better able to recognize these factors that signify an impending recession and capitalize on them. While recessions and bear markets are often accompanied by increased unemployment, decreased wages, a drop in consumer confidence, and a decline in the value of just about everything, all these factors present a golden opportunity to become wealthy if you know how to use them to your advantage. Hi, and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. In this video, I'll discuss what you can do to build your wealth in case of a recession in 2023, what this implies for you and your investments, and how you may use this information to generate money. But before we delve into the topic, make sure to hit like, subscribe, and turn on the notification bell to stay up to date on our videos. Without further ado, let's head on to the video. Recessions are often marked by a sharp increase in unemployment, a reduction in wages, a loss of consumer confidence, and a decline in the value of just about everything, including stocks, food, energy, and services, with possibly global ramifications that endure for years. But secondly, a drop in earnings typically coincides with a recession. Companies report their revenue and provide guidance on their future outlook every quarter, but recently they have been lowering their predictions in anticipation of weak or even negative growth, raising the danger of a recession at the fastest rate in 10 years. This brings us to point 3, layoffs. When customers have less money, they spend less, and when businesses see a drop in demand, they start to cut expenses, with workers typically being the first to go. And now, let's begin with, first, stocks. All three major indexes are currently down between 20 and 30%, and analysts like JP Morgan think that the decline from present levels will continue for another 20%. Although the average bear market decline since 1946 has been close to 30%, the most severe one occurred in 2009 when the S&P 500 plunged 57% from its peak. Now, bear markets often do significantly worse, with an average decrease of 34.8%, which is currently the case as we are down approximately 25% when you combine the average with a recession. All of this is to argue that generally speaking, the absolute bottom happens when investors capitulate. Typically, it is when things start to recover and begin to improve. Second, real estate. Although every region is unique and some areas could continue to prosper, nationwide housing decreases are actually relatively uncommon. In actuality, there have only ever been a handful of occasions during the past 60 years when prices have decreased by more than 10%. But with the consensus on Wall Street now stating that national house prices will drop by 7%, with a worst-case decline of 10 to 15%, should interest rates keep rising? Of course, every market will be unique. The most susceptible markets, such as areas of Florida, Arizona, Idaho, and Southern California, could experience declines of up to 25% from their peaks, with a decline extending another 12 to 18 months before bottoming out. For someone with a fixed-rate mortgage who plans to stay in their home for another 5 to 10 years, it will probably not make a significant difference in the long run. But some deals might be available for those wishing to invest in or purchase a home. Third, keeping money. Evidently, there's been a belief that cash is subject to inflation up to this point. But in some cases, when the value of all other assets is declining, cash may be the safest place to keep your money. And when someone like millionaire Ray Dalio acknowledges that money is no longer garbage, you know it's big. Truth be told, many people overlook the fact that as recently as 2018, cash was the asset with the highest performance. If you had simply saved money in a high-yield savings account, you would have significantly outperformed the market. Even fund managers are holding on to the most cash since 2001, as cash has now grown to be such a large fraction of the portfolio. So let's just think about these reasons why the upcoming recession may be a once-in-a-lifetime chance. First, everything becomes less expensive. Warren Buffett provided an ideal example of this. He claimed that we sing when hamburger prices drop. We cry when hamburger prices rise. Except for stocks, most individuals purchase everything in life similarly. People dislike stocks when they fall in value, and you can get more for your money elsewhere. Reframe your thinking first, since a declining market can be in your favor. Second, there is less competition. The truth is that businesses cut back, collapse, serve cash, and play it safe when times are tough. However, this gives smaller, more competitive companies a chance to stand out and take their spot. For instance, a study involving 16,000 businesses discovered that those that keep up their advertising boost their value and gain more for their money with positive growth years after the recession ended. Thirdly, there are significantly more opportunities since a recession is a market's way of eliminating the unprofitable. A few months ago, Patrick and David drew an analogy between the peaks of the market cycle with a forest. This means that only the largest and most established trees or businesses have access to all resources. In this example, sunlight. It's hard for everything at the bottom to compete, and it's challenging for it to grow. Like natural forest fires, our economy regularly clears out and bankrupts the businesses that can no longer support themselves, creating opportunities for new, smaller companies to grow. Fourth, a bull market always follows a bear market. According to Yahoo Finance, historically, the S&P 500 has dropped by a median of 24% and an average of 29% during recessions. However, after stocks have reached their low point, they typically return 40% the following year, and the market has gained an average of 58% over 2 years. The market has always recovered over the long run in every single case so far in history. Therefore, buying on the way down is significantly more rewarding than exiting the market and waiting. Lastly, fifth, before others become aware of it, you must take action. It sounds easy, but the truth is that recessions are never confirmed until a long time later. For instance, the Great Recession that began in December 2007 was not officially announced until December 2008, only a few months before it ended. However, there are a few things you may do to profit from this. The first is to reduce your spending. This implies that you monitor your market, reduce excessive spending, and manage a lean while continuing to reinvest as much as possible into the market. This should also include a strategy for what you would do if your income dropped by 20 to 50%, how you would cover the difference, and whether you could take proactive steps to protect yourself in advance. Second, keep some money in reserve. While statistics show that you should invest your money as soon as possible, there is much to be said for the peace of mind that comes from keeping money on hand in case you need it as a backup. Third, protect your career. This will ultimately serve as your best insurance against whatever happens because from a financial standpoint, the worst-case scenario is not the market falling, but the market falling at the same time that you lose your job and are forced to liquidate your investments before they have a chance to recover. Therefore, now is the ideal moment to enhance your abilities, pick up new ones, and focus even more on what you're already doing. Following that, make long-term investments. When it comes to investing, simply carrying on as usual and acting as if nothing is happening is the wisest course of action. Dollar cost averaging, or the practice of regularly investing in the markets, has been demonstrated to be the wisest strategy. Stay in the market and keep investing. Then 5, diversify your investment portfolio. Now, if you personally can't tolerate a 20% decline in value without freaking out, you're obviously investing too aggressively. For instance, if all of your investments are in US tech companies, it would be wise to include large caps and foreign stocks and bonds in your portfolio. You might also consider real estate investing or purchasing REITs for their more predictable rental income. The more support your portfolio has, the less probable it is to crumble if one or two of those legs fail. This is also a perfect opportunity to put in extra effort, start a side business, and study as much as possible since everything you put in now will pay off handsomely when the market starts recovering. Thanks for making it to the end of this video. If you enjoyed it, please hit like and subscribe as it would help us extend our reach to many audiences. Also, make sure to leave your thoughts in the comments section down below. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you in the next video.